Is Narayana Health, or Narayanahrudayalaya, a global growth engine or a dangerous margin trap? Today, we are deep diving into the healthcare giant's fiscal year 26 earnings analysis to see if this medical powerhouse belongs in your long-term portfolio. Let's look at the data. The biggest headline here is a massive 75.8% top-line shock. Q4 FY26 consolidated revenue reached a staggering 2,593.81 crore, which is up 20.6% sequentially, quarter over quarter. According to the diagnostic scale, this growth is structurally top-heavy, driven entirely by a massive international play. To find the ultimate truth teller for this investment verdict, we need to unpack the FY26 terminal across three distinct segments. First, the massive top-line surge and UK acquisition. Second, the sharp margin squeeze. And third, the relationship between reported profit and actual cash flow. Looking at the full-year performance, revenue from operations hit 7,896.04 crore, representing a massive 44% year-over-year growth from FY25. Adjusted EBITDA also climbed 31% to 1,792.80 crore, though standard margins are currently undergoing transient dilution while these newly integrated segments scale.
Growth isn't free, and we see a clear margin squeeze with a 530 basis point drop in Q4 FY26 consolidated adjusted EBITDA margins, falling from 26.1% to 20.8%. This happened due to the consolidation of the new UK healthcare acquisition, sharp increases in cross-border staffing, higher global operational expenses, and the lower margin profiling of new international centers.
When we look for core profitability, the reported FY26 profit after tax stands at 810.46 crore. However, the document notes that if you strip out one-time M&A closing fees of 76 crore and a 51 crore labor code gratuity adjustment, the underlying core adjusted PAT actually grew by a strong 18.7% year over year. The company is running on a tale of two growth engines. The domestic India base is a stable profit mint, bringing in 1,250.50 crore in Q4 revenue, up 12.8% year over year. Meanwhile, the international engine acts as a turbocharger, with the Cayman Islands growing 47.9% year over year and the United Kingdom adding £110 million in Q4 alone to drive that 75.8% top-line shock. The domestic India engine is running hot with excellent operational metrics. The average revenue per operational bed, or ARPOB, rose to 1.79 crore, up from 1.59 crore in FY25. Simultaneously, the average length of stay dropped from 4.5 to 4.3 days, meaning they are treating patients faster and maximizing bed turnover, hitting 220,000 total Indian inpatient discharges. The massive UK bet involved acquiring a 100% equity stake in Practice Plus Group hospitals for an external cash outflow of 2,200.97 crore, funded via 2,958.56 crore in fresh long-term bank funding. The immediate yield was substantial, delivering 110 million pounds in Q4 operating top-line right after the acquisition, acting as a successful geographical premium risk hedge. Tracking the leverage shows a heavy debt load. Total borrowings increased significantly to 4,866.18 crore, up from 2,215.83 crore, expanding the debt-to-equity ratio to 1.29x, while the net debt-to-equity stands at 0.49x. Despite the debt load, the company maintains a strong liquidity shield. They hold a massive cash surplus of 2,129.20 crore in reserves, keeping their current ratio tightly stable at 2.15x. The final verdict here is that while leverage expanded for global M&A,
short-term asset cover remains fiercely protected.
The ultimate truth teller is the earnings quality matrix. While reported profit after tax is 810.46 crore, the actual cash from operations is double that at 1,621.19 crore. This stellar 2.0x cash flow to PAT conversion ratio validates an extremely conservative revenue accounting lifecycle, leaving a structural free cash flow of plus 746.01 crore even after a heavy 875.18 crore core capex. To summarize the green flags, cash flow dominance proves that accounting profits are fully realized into liquid treasury inflows. There is working capital mastery as inventory turnover scaled sharply from 16.96x to 21.82x despite cross-border expansion, and the core domestic health in India is pristine, with rising ARPOB and falling stay durations. However, keep an eye on the orange flags and risks. Heavy one-off usage like M&A fees and gratuity charges obscured baseline operations. There is foreign exchange debt exposure across $117 million and £150 million. Furthermore, an incubation drag from new retail and health insurance platforms logged a 124.19 crore operating loss, alongside aggressive capex expansion pipelines requiring careful monitoring. For the valuation context and outlook, the market view is neutral to constructive. Current multiples reflect a premium for absolute growth, alongside a mild discount for short-term margin contraction. As asset utilization curves in these new UK and international geographies normalize over FY27, profitability should catch up. So, what's your take on Narayana Health? Drop your thesis in the comments below. And if you found this earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.